All right, we're now recording, so glad to have everybody here. Thanks for showing up today. So this is a webinar about how to make big pips and what you need to look for, and we call this webinar Trading the Wide Open Spaces. Okay, so but first, as in any webinar, nobody's told you can make $3 million in 2 weeks. The possibility exists you could sustain a loss of some or all of your initial investment. Therefore, you should never invest any money you cannot afford to lose. Be aware of all the risks associated with foreign exchange trading and seek the advice of an independent financial advisor if you have any doubts. All right. So there are many ways to trade the Forex. Okay. There's swing trading, there's scalping, there's range trading, there's position trading, and there's target trading. And that is what we do, target trading. All right. So most traders fail, however, because they cut their winners short and they let their losers run. And we all know that it's easier said than done, but the opposite has to happen. You have to let your winners run, and you got to cut your losers short. So let's just take a minute to understand what we need to know to target trade in the Forex. All right. So how do we remember what we got to need to know? It's a little acrostic that we came up with that says we got to trade for pips daily. That's what we want to do, is trade for pips daily, and each one of those first letters stands for something we got to know in the market. The T stands for the trend. F stands for the fibs, or the Fibonacci ratios, and the P stands for previous support or resistance, all right, depending on the direction we're going. And then D stands for divergence, or the end is near, all right. If we know those four things about a currency, so that makes it a very simple thing we got to find. If we know those four things about a currency, then we have put the odds on our side. So let's kind of drill down on this for a minute. All right, we have to know the prevailing trend. Okay, so in this illustration, it's down. But then we also need to know the trend of the day, because the trend of the day may be opposite of the prevailing trend. All right, as the market corrects, it goes opposite of the prevailing trend. All right. Now, when the trend of the day matches the prevailing trend, that's when we get wide open spaces to the downside. And that's where the opportunities exist. It's just the opposite in an uptrend. We would be going looking for the open spaces above. Then we need to know the previous support or resistance. We call them PSRs for short. We need to know the fibs, not just the fibs in the big picture, which is on the 240-minute chart, but we also need to know where the Fibonacci ratios are in the smaller world, which would be in the 60 and maybe the 10 or the 15-minute world. Is divergence in the market? If divergence in the market, we do not stop trading in the direction we're trading, but we're more judicious about moving our stops. All right? Are there any patterns that are influencing the traders? Are there bear flags, bull flags, head and shoulders, inverse head and shoulders, rising wedges, falling wedges, rectangles? All those things are things that influence the traders today. And what are the most important targets? They are PSRs, previous support or resistance. So let's understand them. So I'm giving you a little illustration here to kind of get it in your head. Now, PSRs are not hard, but they're hard for your head to recognize, okay? The reason is your brain does not like when you tell it that support is now resistance, it goes, no, support is support. Resistance is not resistance, it's support. No, resistance is resistance. So we got to kind of get it in our head. How do we get that into our head? Okay, so here's an illustration that I came up with that kind of helps, all right? You know, when you're in a Forex, in the charts, you are always living on the second floor. No matter where the candles are, you are living on the second floor, all right? Now, if I was going up, I would need to find my ceiling. Well, I don't know where my ceiling is when I live on the second floor, but if I could find the guy who lives above me, and I could find his floor, I will have found my ceiling. If I'm going to the downside and I've got a downtrend, I don't know where my floor is, but if I could find the girl who lives below me in the apartment below me, if I could find her ceiling, I would then know where my floor is, all right? So it's kind of an easy way to keep it in your head. What am I looking for? What am I looking for, all right? So I'm going to first do this, by the way, in a PowerPoint, and then we're actually going to go in the charts, and I'm going to do it for you live. So hang on. Let me get this stuff out of the way, and then we'll actually do it live in the charts, all right? As you can see here, I've marked the supports, all right, all the way up on this move, all right? So support looks like this, and I didn't come up with support. Tom DeMark came up with support. Tom DeMark says what support is 2 candles to the left and 2 candles to the right of 1 candle that sticks down at the lowest point, unless, of course, we have a set of twins. If we have a set of twins, then the twins act as 1 candle. All right? So we have audio done. Somebody type in we have audio, Raymond, maybe. All right. Somebody type, we have audio, so that Deanna knows she's got it. Hello. All right. Thanks, Max. All right. All right. So now resistance, when we do a downtrend, will be just the opposite. It'll be 2 candles to the left, 2 candles to the right, and 1 candle that sticks up, unless it's twins, in which case the 2 candles act as one. All right. So I've taken those lines and just gone into the future, and we can see how the market knows exactly where these lines are. All right. So they become targets. All right, and they're the big boys' targets. All right. So let's take this thing. We want to, what we call this is trading the wide open spaces, okay? As the market takes off, there's a wide open space right there, and you see the market moves there. Once they break into the next area, we're going to the next target, all right? And in this case, they blew right through it and went all the way up to the top. Now, when that happens, they can't continue that move because it's an unsustainable trend. So what do? They correct it, and they bring it back down to the bottom. Now, here's the interesting thing. Once they have taken out a target, they are no longer targets. They are maybe barriers, but our next target is going to be this line right here. And notice what the market did. All right. So once they correct, they go right up to that target. There's a great opportunity right there. All right. Now, right here, they have broken into this new area, an area where they want to trade in, and this is our new target. But they don't get there. So what do? They do an ABC correction to the downside right here. You'll all see that. You can see that that's going to be a 50% fib, all right, retracement. And when they go again, this time, all right, this target is no longer there. This target is no longer there. This is the next target, and maybe these ones right up here. So what did the market do? It took off, and up she goes right to those targets, all right? And then we finish off up here. Now, again, all these are unsustainable moves, so they correct the move. Correct it back down. You can see there's a Fibonacci retracement. More than likely, it's a 786 retracement. And now they have taken out this target, and this target. So our next target is right here. Can everybody see what they did? They went to the target, all right? So that's big opportunity, and what do? They take it, and of course, that's the way we trade. So what is important? In an uptrend, we care about past support. They will now be our new resistances in the same price area. All right? In a downtrend, we care only about past resistance because they will be our new supports in the same price area. This is why your brain rejects it, because when you say support is resistance, it goes, no, 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 support is support. All right? I learned Spanish when I was 40 years old. And at 40 years old, I've been calling garbage garbage for 40 years. And when I learned Spanish, they told me, they said, no, it's now basura. And my brain said, no, it's not. It's garbage. No, it's basura. And my brain said, no, it's not. It's garbage. And I had a hard time with understanding that sort of stuff until my brain finally clicked over and understood that, oh, yes, it can be both. All right? So same thing in trading. So what we want to do is trade the wide open spaces. All right? That's where the opportunity exists. So the keys to successful target trading are knowing the trend, know the fibs, know the previous support and resistance levels, and the above targets are only found on a 240-minute chart or higher. And we don't trade the day chart, we trade the 240-minute chart. But if you're down on a 60-minute chart looking for this stuff, you are already too low. All right? We use strict margin management, never more than 2% of our account. And we trade the trade setup when the opportunity arises in those wide open spaces, and we go for the targets. In other words, if we don't have a wide open space, we do not trade. All right? Now, the targets are from the 240-minute chart, so that means that time is a factor. Because when you're trading in the Forex, you should only be trading the first 2 to 2.5 hours. So if your targets are from a 240-minute chart, you know that's 4 hours already. All right? So obviously, time could be a factor in getting to your target. Right? And also, don't expect your trade to exceed its ATR or its average true range just because you have a trade set up and found the target. If we have an ATR of a currency of 100 pips and the target is 180 pips away and it only does 100 pips a day, that's its ATR, then that means it's a 2-day trade. All right? So we need to understand that kind of stuff. Now, if you knew the targets, you can make great risk and reward trades, and unless you know the target and the stop loss, you can't even assess true risk and reward. That's one of the problems that retail traders run into. They've got a 30 pip stop on the trade. It starts to take off, and then all of a sudden it starts to back off, and they're up 12 pips. They go, oh my gosh, and it's not going right. I'm going to click it out. All right, well, they just risked 30 pips to make 12 pips, okay? Yes, it is, Diana. Let me tell her. I don't know. I guess she can't hear it, so. All right. So that's what ends up happening. Why do traders bail on their trades? Because they don't know where it's going. That's the reason. I don't know where it's going, and I'm up 12 pips, and my gosh, I can click the thing out right now, and I'm 12 pips more than I had before. And so they click it out, and they totally ruin the trade. Right? They have risked 30 pips to make 12, not even they're risking 2 to not even make 1. Right, number one, and they have put way too much money at risk for that little dinky trade, and then they watch as the currency turns and goes right up, and they go, man, I should have stayed in that trade. Well, why didn't you stay in the trade? Because I didn't know where it was going. Well, we can know where it's going, right? So with a high degree of probability. Now, if you knew the targets, you would always trade with at least a 1-to-1, and we rarely do that, and most of the time 1-to-2, 1-to-3 risk to reward ratio. If you knew the targets, you would not trade right into a target and they get slammed and then blame your broker. So you make a trade and it goes 4 pips, slams into a target you didn't even know was there, rocks back 40 pips, stops you out, and what do you say? Ah, the daggone broker stopped me out again. No, the broker didn't stop you out. You traded right into a target because you didn't know where it was. And this webinar is about showing you how to know where they are. Right? If you knew the targets, you would trade only in the wide open spaces. You would conserve your margin for the most opportune area to trade instead of just sitting in the market trading for the sake of trading. What happens to traders? Traders want to push the button.
You push the button. I didn't tell him to push the button. Did you tell him to push the button? Oh, I didn't tell him to push the button. I didn't tell him to push the button. You didn't just go push the button. You don't go around pushing the string button. I tell you, don't push the button.
Don't push the button until your trade comes to you. All right? So, traders spend way more time and emphasis on trying to find a trade than they do managing and exiting the trade they just put on. Because they major in the entry and they minor in the exit or the target. They bail and they never take advantage of the opportunity. All right? So let's take a look and see what trends are. Trends are less than 45 degrees. They can't be greater than 45 degrees. All right? So how do you remember what it is? In a downtrend, it's 10 o'clock to 4 o'clock on your watch. In an uptrend, it's 8 o'clock to 2 o'clock on your watch. Okay? Now, this angle right here can be sustained indefinitely. All right? They don't ever do that, but they could sustain that indefinitely. Or this one to the downside could be sustained indefinitely if they wanted to do that. All right? Now, here's what happens. When the market is moving, there we go. When the market is moving, we get spurts of money that come up, and because that's unsustainable, they bring it down. And then they do a spurt up, and they bring it down. They bring it up, and spurt it down, up, like this, okay? So the trend is intact, but the moves inside the trend are unsustainable. And this is why traders get whacked, because they don't know where this target is, and so when it starts to pull back on them, they bail on the trade. That's what they do, all right? So I was a retail trader once, and I know exactly. I'm telling you from experience. I'm not a natural trader. As a guy that had grunted out. So I know exactly where you are, been there, done that, got the T-shirt. All right? So let's take a look at trends for a second, because the most important thing, and the initial thing, is we got to know the trend. If we don't know the trend and we get it wrong, we will be looking for the targets at the wrong spot. That's where we'll be looking for them, in the wrong spot. So as you can see, once we make the turn here, then we're looking for trades to the upside. All right? When we were coming down, we were looking for trades to the downside. All right? Now, I want you to see in this example here that the thrusts here are all unsustainable. The trend is sustainable, but the thrust inside the trends are not. Now, why is that important? All right? I'm going to take the same move and I'm going to put the targets on them. All right? Now, we have a simple tool, I'll talk about it later, which just puts the targets on for us, okay? But I want you to see why the move happened, all right? You see the wide open space right there, all right? So here, they took out this target here, they pulled back, therefore the next target is right here. What did they do? They took that trade. It's unsustainable, therefore they pull it back, All right, that's why it's important for you to know where that is, because if you trade right into that deal, and they're going to pull it back because it's unsustainable. All right, and that's where traders, they make a trade, it goes 5 pips, they get whacked on the pullback, and they go, the doggone broker took my stop. No, the broker didn't take your stop. You put a trade on here, and you never should have. Why did you put a trade on here? Because you didn't know that was where the target was. All right, they pull it back, and off they go. What happens then? All right, notice the next move. Totally unsustainable, up to the target. What do? They pull it back. All right? Here's the next move. Once we break this resistance across here, where are we going? We're going to the target. You see that? And as the trend continues to go up the hill, the targets get bigger and bigger and bigger. Why is that? It is because more traders have recognized the trend is holding and it's staying intact, and more traders are becoming participants. And that means that the targets get bigger because the move can be sustainable for a longer piece of real estate. All right. So here's another little one right here, up to the day chart top. Bam. So the question then becomes, can we know the targets? All right. So let's take a little schematic. Let me get through this, and we're actually going to go do it live in the charts. All right. So let's go back where this trend started and see how we find the targets. All right, so here we go. We have a breakout. As soon as we know it's not a false breakout, we go look for the targets. All right, but it's the start of a new trend. All right, so the first stop is to put the Fibonacci's on. All right, that's the Fibonacci ratio from the swing high to the swing low, and that gives us the 786, the 618, the 50, and the 382, and the 214 fib in here. These are going to be interim targets. All right, they may be the target, but they are, at the least, they're an interim target, and at the most, they are the target. And you can see instantaneously that the market knew exactly where this was, and it stopped dead right there. All right? That's an unsustainable trend, so we know they're going to pull it back. So we wait for the pullback. All right? All right, so remember, the wide open spaces are the unsustainable areas, which is why when you make a trade in an unsustainable area, it is the opportunity, but it means you need to know where the target is so that you can move your stop and maximize that opportunity. All right? So, no, it's mindful traders. Raymond, I don't know what you're talking about. This is a trader for the all the traders over at with Randy Howe. Okay. All right. Now we have a proprietary target tool. It's called HSI. So it stands for Historical Statistical Indicator. It has Fibonacci ratios and historical support and resistance built into it. It's a tool, but it's proprietary. But the information it gathers is classical technical analysis. We use it, one click, and we have confirmation. Okay. Now it's the same thing when you put Fibonacci's on. Okay. It's a tool, all right? It's just got them programmed in there, and you use a Fibonacci tool. That's it. All right, so we're going to add those on here, and you can see there's the R3, the R4, and then there's the R5, okay? Those are the resistance to the top. Now, in a trading environment, real trading environment, we'd also use the actual PSRs, which I will do in a minute. But right now, I'm just trying to make this simple, all right? So let's take a look and see how the market moved. The trade are the wide open spaces, so that you don't trade into a target. Notice right here, all right? They pull up to this target, they take out the 618, pull back. The 618 is gone. Where's the next target? Right here. What did they do? They took the trade. See? Because all the big boys know where they're going. Big boys know where it's going. Retail traders haven't got a clue, and that's why they keep continuously blow out. All right? So over here, we pull back again. We make another move at it, okay? So the unsustainable thrusts occur in these wide open spaces. Here's another one right here, all the way up. All we would simply do on a trade here, once we got the pullback here, is we would move our stop here and try to stay into the target. That's all we would do is move the target. That's how hard it is. Find the target, move your stop at any barrier to getting to that target. All right? That's just that simple. All right? All right, they make another valiant attempt at it, and they're not successful. Now we know that that's the top. And what happens? The charts tell you where it is, and down they go. Bam, like that. All right, so let's look at a down move. All right, here we got a down move, so we're going to do the same thing. We're going to back up here. All right, we're back here. We have a breakout to the downside. As soon as we know it's not a false breakout, it's a real breakout, we will then we'll say, okay, it's a new trend. Let's start it. All right. So we first stop, put the Fibonacci ratios on. from the swing low to the swing high. All right, we're up on a 240-minute chart. All right, a 240-minute chart is doing this. All right, so these become the wide open, the interim targets, and then we're going to add the HSI tool. All right, so we add that tool on here, and now we see that the next target is the S4 here, and the next target is the S5. Now I'm showing this really important. This is important to you because I want you to see why you need the fibs. Some people say, well, why don't I just use that HSI tool? And you're going to find out here in just a second. All right. So the trades are the wide open spaces. You don't trade into a target. All right. So there's the first trade to the target. There's the second attempt to break it to the target. There's the third attempt. They make it. All right. All right. Now they try again. They're not successful. There's the bottom. It's a 786 fib. All right. Now, the charts told us where the bottom was, and now we know that our target over here is not going to get there. All right? So even though we had a target there, it couldn't make it to there. And that's why you have to use both Fibonacci's and previous support and resistance. Because anytime it doesn't make it to the target, it's because it ran into too tough of a fib. All right? So let's do a couple more here, and then we're going to go live in the charts. All right? There's a support. There's a support. There's a support. There's a support. There's another support. There's another support. All right. Now, back to that. Sorry. All right. Now, these supports will be resistance in the future. Again, that's why your brain rejects it. And it goes, no, support, support. No, support is now resistance. All right. I'm showing you this move here because I don't want you to think that I just went and got some chart and drew some lines on it and said, see, that's where they go. I want you to see this when I go to the next side so you know that it wasn't cherry picked. All right. There's that same move. All right. So these lines are irrelevant on the down move, but they're everything on the up move. What does the market do? Right to them. 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 You see? And where are the opportunities? It's the space between those lines. That's where the opportunity is. All right. So here's a FedEx logo. All right. Now, almost everybody in the world has seen a Federal Express logo. The question is, can you find the arrow? Can you find the arrow for me? Question. Nobody wants to answer. Everybody's scared. It's between the E and the X. All right. Now, if you have never seen that arrow, you will never see a FedEx logo again without seeing the arrow. And that's kind of what a trade setup is. In the chaos of what those candles are, there is always a trade setup, there is always a target, and there's always a move that is underway somewhere. All right? So, whatever your trade setup is, whatever that is, how you get into a trade is not important. What's important is you make that trade only in an area where you have the greatest opportunity. So now I've taken this down to the 240 world. Okay, now you can see in our world, it's these little arrows and painted candles as our setup. All right, and you can see here's the wide open space, and you see you have 1, 2, 3, 4 opportunities at that one. Notice when they break here, they go right down to the targets. When they break here, they go right down to the targets. All right, now regardless of what your trade setup is ours. Would you have confidence to trade and stay into those targets if you knew where they were? Because as you see, the market knows where they are. All right, that's number one. Number two, would you know not to trade those signals because they're too close to the target? You see, that's where traders usually get whacked, is right here, and then they miss the move down here, or they get a move down here and it retraces on them and they bail on the trade, like right up in this area, right up in here. They get a trade and it pulls back on them and they go, oh, no, 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 I'm clicking number 5, and then of course the move pulls up, finds enough sellers to make the move, and down it goes. See that? And now instead of having one trade that you took 5 pips on and bailed, now you have 3 opportunities to trade it to the target. And that's why traders who know how to target trade make thousands more pips than traders who retail trade for 5 to 8 pips. All right? So targets are only found on the 240-minute chart or higher. We confirm on a 60-minute chart. We enter and exit on the 10-minute chart. Why? Because the 5-minute gives too many false positives. If you're trading on an MT4, you only have a 5-minute chart. Why is that? Because it only has, it gives too many false positives, and the broker pays for that broker station for you. So that's why. And we never trade on a 5-minute chart. All right? So in actuality, we are trading the 240 and the 60-minute chart and we're simply finding an entry on a 10-minute chart to the target. So let's go into the charts now and do it live. I want to prove to you that it really does do that. I've got blank charts here. You pick a chart. Somebody tell me a chart to look of the 9 majors. Somebody pick a chart. I don't care what it is. Come on, somebody. I'm talking about a cross, like a euro dollar, pound dollar, Aussie dollar, whatever it is. Euro Aussie, okay. Melissa gets it. She's first. Oh, I went to the British pound. All right, so we'll go over here to here, and we're going up to the 240-minute chart. All right. So this is, by the way, how you practice it. Okay, you take a move that's already in play. You've already seen it. This is how you practice it. All right. So you go up there and you say, okay, I want to see if I could have found the targets from here and here when it made the turn to the upside. So we're going to trade this area right in here. I'm going to put a top on here, and I'm going to put a bottom here so I know where I'm looking for in the past. Now, normally you're looking for the price line. Right. So now, I'm going to pretend that this has not happened here to the upside, right? And I'm going to, how do I do that? I'm looking for my ceiling. I'm living on a second floor down here. Where's my ceiling? It's the guy who lives above me's floor. So what I have to do is go back in the past and find a 240-minute trend up to this line that will give me those targets. So I got one right there, but I'm going to see if I can find one further back here that does the whole move. There we go. All right. So here's a move from here to here in an uptrend. All right, I'm looking for supports. All right, so I can see I have one right here. Excuse me, right. This does not create a higher high. One of the things it has to do is create a higher high. All right, so I got one right here, right there, set of twins up, and then that doesn't create a higher high. That doesn't create a higher high. That doesn't create a higher high. But this one starts this whole move that goes up to here. There's a set of twins that creates that higher high. There's a support right there that creates that higher high, and there's one right there. This set of twins is to the left, to the right, and it creates that higher high. Oh, thank you. No, I'm on a 240 actually, Fabio. It may not have shown back up on yours yet. Thank you for that heads up, though. It is on a 240. It's a lag on your end. That's all. All right. So now I have these. All right. Now I'm going to go back in the future, back to that line where we started. All right. Come on, baby. Back to it. Right, here we are. All right, here we are. All right, now, I know this already. Here's what I already know. Wait a second, what happened here? Hold on just a second. I lost my, there we go. There we go. Lost my drawer. Okay, sorry. All right, here's what I know. If I can get a trade in this area, that's a wide open space. I'm going to trade it. I will not trade this area. This is from 32.86 to 32.50. So that little space right there is actually 70 pips. So I'll trade that spot. That's 70 pips again. There's another 70 pips here. And 81 to 81, there's 100 pips here. So I know that I will trade this area, this area, this area, and this area, but I will not trade this area. Now, the only way I can trade this area right here is if they take it out and pull back. All right, so let's just see what happens here. All right, and they go up and take both of them out right there. So these are now gone. So the way we do that is we take them out. Notice they went right to target. They know where the targets are. All right. Notice that it was a unsustainable trend. All right. This is unsustainable, so we expect a pullback. But now, when they pull back and we get a retracement, they got to square this, going to come down in this area. Our next target is here. Everybody see that? That's our next target. So let's go see what happens. All right. They're doing a sideways move, and up they go right to it. All right. Do a sideways move instead. This target is now taken out. If I get a pullback, all right, notice that was 70 pips, folks. Don't forget that. That was 70 pips. So that target is now taken out. All right, and now I'm looking for this target. If we get any pullback at all and go, I'm going for that target right there. Let's see what they do. They pull back. I'm looking for a signal to get in. Boom, boom. They take them all out right there. And where do they go? They have not hit this target yet. See that? They have not hit that target yet. So these are gone. Any pullback I get, I will be looking for that next target that I'm not dashing. This one's gone. Notice they took them all. These are big moves, folks. Way more pips than 5 to 8 that the average retail trader is. We now got a bull flag, break of the bull flag. I know the break of the bull flag comes at 3,500 right in here. 3,500. I'm going to 3,581. 80 pips there. All right. Anybody interested in 80 pips? All right. Let's see if they do it. Bam. 80 pips. Do you think they knew where the line was? Look at right to the line. Every line we got, it went right to it. All right? That's what happens. Let's put the fibs on and see where they stalled at. All right? So we got a swing low, swing high here. Put the fibs on and watch as they use those interim targets. So remember, the interim targets, when they stalled out here, trying to get to that target, why did they stall out? There's a fib sitting right there, okay? When they broke through here and stalled out here, what's that? 214 fib is right here. That's why they pulled back, all right? When they broke, they went up to the 270 fib extension. That's where they stalled out right there. Did not take the target out. See that? All right? That's why you have to use both of them. All right. Let's try another one. I want you to think, give me a currency. I'm here to prove to you that this is the way you need to trade. Give me a currency. We've already done the euro. If you get a chance not to, dollar yen, okay, so. If you get a chance not to trade the dollar yen, don't trade it. I mean, the euro dollar. All the dumb money's in the euro dollar. Now, why is that? Because it's only 1 or 2 pips to get in, man. So all the dumb money's in the euro. So since all the dumb money's in the euro dollar, that's also where all the black boxes are that are designed to take stops. So if you don't have to trade the euro dollar, stay out of it. All right? So let's take this move to the downside here. I'm on a 240 chart. Let's just see if we can find this move to the downside. Let's start here at this top. We're going down this bottom right here. All right? So now in the real world, we wouldn't be putting these lines on. We'd be looking for where the lines are. Right? But I'm just going to show you how you can prove that it works. Okay? So here's the top. Here's the bottom. So I'm breaking down here. That means I need to find my floor. If I got to find my floor, that means I got to go in the past, find a downtrend that goes from the same move, and find the ceiling of the girl who lives below me. All right. So here's a downtrend right here. All right. Don't have to go very far back. All right? Again, what I'm looking for is I'm looking for resistance that creates a lower low. Resistance that creates a lower low. All right. Resistance that creates this lower low. A resistance right here that creates a lower low. All right. Oh, there's one right here. To the left and to the right, right there. All right. That's what I'm looking for. All right. So we'll draw those lines. All right. We already got that one there. We'll take this one right here. And we'll go down to this one over here. And we'll go to this one right here. This one right here. No, they're just high lows is all so that's all they are. Just high lows, nothing. They're not Dungeon channel. It's just so we don't have to find the top of it. We don't have to find the actual candle top. When we're looking to put anchor things on, we can find a high low there. All right, and we can't take this one. You see this? Because it doesn't create a higher low, so we can't take that one. All right. Do you have any other downtrends over there? No. Now you can see there's a huge wide open space here. Right? Huge wide open space, and you can see what they did in that. They ran it. All right. Now I need to make sure that there is nothing in here. That the reason they ran it was because there is nothing in here. Everybody see that? Nothing in here. That's why they ran that thing. All right. So we're going to go back and make sure there's nothing in a downtrend even further back that will stop that thing. All right. And we look over here. Here's the next downtrend. There's nothing here, folks, except for this one right here. All right. So we'll mark this one. This creates that lower low right there. All right. Wide open space there. All right. Now we're going to go back to current to that spot where we were at, right here. Now here's what I know. I know that I'm going to trade that area. I know I'm going to trade that area, and I am not going to miss that area, and I'll be very leery of this one down here. Can everybody see that? I know that now. And you will know that if you do the lines for future moves, even though they haven't happened. We're practicing in the past. All right, that's how you practice it so that you know how to do it in the future. All right, so let's watch and see. Did they know where the line was? They stalled out right here on 2 candles. Now break it into here takes this out. All right. So I'm going to change this to dash, and that means that if I get a pullback, any pullback up here, my next target is right down here. Now they could run this thing 1995 to 97. It's a 75 pip move. If they run it, I want to find a way to get in the trade. All right, they ran it. I wonder if they knew that line is. Gee, I don't know. You think that doggone Scott? He is so lucky. Went right to the line and set a set of twins on it. How did he know to do that? Because this is what they do. All right. Now, if I get a pullback. All right, this target is gone. They just took the target out. So now my next target is down here at 98.59. Any pullback, that's the best thing that can happen. See, once you become a target trader, a retracement and a pullback is your friend. That's your friend. Right now, as retail traders, a retracement and a pullback is your enemy. Why? Because you're upside down in the trade. That's why. But you won't be if you learn a target trade. Now, when I get the turn here, I'm looking to go all the way down. Look what they did. As soon as they made the turn, you see the wick went right through it, right there. Bam, right to it. How far was that? That was 95 down to 59, okay? The next one, it was a 140 pip move. 140 pips. Anybody interested in 140 pips? Don't forget, I'm on a 240-minute chart, though, so look how long it took. 1, 2, 3, 4. 3 candles. 3 times 4. All right? So it took 2/3 of a day to do that. Okay, that's fine. I can handle that. All right? Now, this target's out. Wow. I am not going to miss this next move because I already know it's a big move. All right? They've already told me in the past, we rock it. 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 Okay, you better rock it because I'm going to be in it. That's it. All right. So, and remember, I didn't pick this currency. You guys did. So I don't know what it's going to do. I haven't got a clue. Pulls back. Oh, baby, come to Papa. That's what I love to see is a pullback. Down they go. Another pullback. We're in that area. We broke into the area and we pulled right back again. So the target is still on. A big pullback now. All right. And what do they do? Oh, gee. Where did they stop? Right on the line. Doggone it, that guy is so stinking lucky. Look at that. Stopped right dead on that line. Why? Because that's what they do. All right? So, that's gone. We'll dash it. Now, a pullback gives me the opportunity down to here. So if I get any pullback, I'm going to take it. If it just runs, it's going to be hard to take it. Well, no, it isn't. It's 40-some pips, as you can see. So maybe I could take it. All right, there's the pullback right there. Pullback. What is that? That's a Fibonacci retracement. That's a 50% retracement right there. 50% retracement down to here. All right, 97.40 to 96.66. All right, 80 pips from that 50% retracement. The retracement is your friend now. All right, I'm looking to go. Let's go. 50% retracement. Turn and go. I'm in. All right, boom. Right smack to the line and stop dead. Daggone it, he did it again. He is so lucky. Wow. I'm not lucky, folks. This is what they do. That's what they do. All right. Now, let's take this same move down, and let's move it down to the 10-minute chart. All right. And let's see how many opportunities we would have to trade to the downside in this move. All right. Let's see if I can get back that far. Hopefully I can. Going back, going back. I can't get all the way back there. It's too far back on this chart. Let me try the over here on the euro because it was a pretty recent run, I think. Yeah. Okay, let's try the euro. Maybe I can get back as far on the euro. If not, we'll just take one. Come on. Wow, got to go way, way back. Come on, it's not out there. Ah, I can't get back that far. Let me do that dollar again. We'll just take the last part because we know I can find that last part here. Okay, so we're coming down. We know this is the bottom down here. All right. So the histogram. This is a MACD. Okay, but this MACD is from the 60-minute world. Why would I be on a 10-minute chart with a 60-minute MACD? Because the big boys trade the 60-minute chart. I don't want to look at a 10-minute MACD. That's worthless. Find out what the big boys are doing. All right. So here's our first trade set up to the downside right here. All right, down it goes. Bear flag, break, down she goes. Bear flag and a gap. So that's over the weekend. When they reopen, down they go. Then they pull back up with a big bear flag. All right. So once we get the bear flag back up, all right, there's a trade opportunity. There's a trade opportunity. There's 2 trade opportunities. Okay, and right here, all right, now this is a difficult one. You can't make this one. Why? You're at 68 and there's 97.50. Never trade into an even number or a number that ends with a 50. The reason for that, there are option contracts sitting on there. You have to be far enough away to move your stop to break even because exactly what happened here is normally what happens. It pulls back away from that even number. All right? So never trade into a 00 or a 50 number unless you can move your stop to break even. All right? Up she goes. To see if you try to live through that, you'd be really in trouble. All right? Up she goes, a big pullback. Now we're starting to move down again. Down to this line. All right. How many opportunities we have to trade to the downside? 1, 2. There's 3 right there. All right. Notice these moves all went. They still pull back. Why? Because they're unsustainable. Can everybody see? That's unsustainable. That's why they pull back. They can't do those. They can't. They have to trade, pull them back. All right. So retracement's your friend. We make a retracement. We make the turn over here, and wow, opportunity, 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 and this one. This is right below the 97.50. So yeah, we'll take that one. All right, and it doesn't go anywhere, but it does go down to 97.20. So it went about 30 pips, not very much, but it went 30 pips. Well, see, that's a great question, by the way, Celso. I hope I'm pronouncing your word right. All right, we're finding the targets up on those big 240-minute charts, right? Yeah, so it's a great question. But we're going to actually enter and exit on the 10. All right. So as we watch the currency come down to the downside, we'll be watching that. We know where the target is, but because we're doing that, we're moving our stops so that if at any time they pull back. Especially now, right in here, we're not so concerned because that's sustainable. Well, what happens when that happens right there? Can you see that? That is unsustainable. So when they pop that one and our stop is up here, we move our stop down in here really quick and protect all this profit. And sure enough, we're going to get stopped out. But we got stopped out with that, and the target hasn't been hit. So remember, the retracement is now our friend. We hope it goes back up so we get that trade. See? So that's a great question, by the way. All right, so up they go. They're not making any real move yet. All right, now we're starting to see a move to the downside. Nothing yet. We're getting a pullback. Wonderful. Can't be better than a pullback. All right, now we're back up here knowing that the target is here. All right, down she goes. This is all sustainable, so we're just managing the trade, managing the trade, managing the trade. Now, we got an unsustainable part of that trend. Right? This part would have all been sustainable. That part is not. So what can we expect? A pullback. We hit the 618 fib. That's why we got to have fibs on here. The 618 fib says, okay, you started this trade either here or here or here or here, one of those places up there, maybe here. You started that trend, and you're up here, and now you're up, down, and you're up 50 pips. All right, what should I do when I hit a 618 fib after an unsustainable trend? Does the chart tell you? Isn't it telling you, move your stop? I am unsustainable. I am going to come back up. I may go, but I'm not going to plan on it going because it's unsustainable. Let's see what they do. They went ahead and did it. But if I move my stop, I'd still be in the trade, see? And what do most traders do? The minute it pulls back, they bail on the trade. They bail on it. Why? I don't know where it's going. It's pulling back. I'm up 12 pips. You click it out. And that's what happens. And what do the professional traders do? They go, nah, baby, I'm not out till I get to here. I just keep my stop up above all this stuff. Working my way down. See? When you hit the target, bam, immediately. Why? That's unsustainable. See? That's unsustainable. Unless it's doing that, like there, it's unsustainable. That's unsustainable. This is unsustainable. All these are unsustainable. So when you teach yourself to recognize it, teach yourself where the targets are, then you're in great shape. Let's go up to a 60 on this move here, and I just want to throw on the HSI tool. Okay, so the HSI tool is a little tool that we developed that has Fibonacci's and these historical support and resistance built into it. All I got to do is go up and find a top and say, I'm a seller. Go find the targets. Fetch, Rover. Go get them. Boom, roof, roof. And the dog goes out and finds them. All right. Now, any place I have confluence, which is where I have this right here with that number, there's two things that tell me that's my target. Can everybody see that? It says there's your target. You're going down here. All right. So what do? That's my trade right there. Oh, gee. And look at it, went blew right through that, went to the next one. Now here's my trade down here. That's where we're trying to go ultimately, and maybe down to here. Let's see what happens as they blow that back down. All the way up, big pullbacks there. We love pullbacks. Right, down they go. Notice every line I got on this chart they use. Right, they used every single line here, there, and there. And the area between here is where the trade exists. Works on anything. It works on anything, but we only put them on our charts, Chelsea. So if you're trading currency futures, yeah, it would work fine. All right. We also do the Dow. The Dow does the same thing. It's crazy. And we also trade silver. So, and as we keep going, another big pullback. And once we get a big pullback like this, 100 pips or more, then we're able to put a second one on because we're actually trading the waves. That's what we're actually doing. Is trading the waves, the Elliott waves to the downside. So there's our second one. All right. Now we got two shots at here. You can see here's our first wide open space, and the next move down, there's the next one down here. So there we go. It's all about having the right tools. Down she went, right to the target. All right. If we break there, go into that target, and alternate. Look at that. Used every line I got on this chart. See that? Now, did anything I showed you, is it rocket science? Do you need to be a stinking genius to figure out how to do this? No, you don't need to be a genius. All right? The market does this day in, day out. That's what they do. And that's how we trade. I'll take you over our charts where we're working on them today, so I want you to see this is how we work on charts. There's the euro dollar for today. This was what we're looking for this opportunity right here. That's what happened last week. We got that trade. All right? See, that's a big wide open space. What did they do? They took the trade. All right? Go over here to the British pound. All right? We're looking now for it to possibly, if we get the break to the upside, all right, if, that's a big if, can everybody see? That's where we're going. They've taken this target out, this target out. We're looking for that right there. All right? This, when we took the move up here, there was the first trade. There's the second trade. Wide open space. Unsustainable, so every time we hit one of these, we move our stop, move our stop, move our stop. All right? Very simple. All right? In the trend. 80% of the money is made with the trend. 20% is made against the trend. So don't trade against the trend. You're trading against the big boys. All right? Here's the opportunity we're looking for in the Swissy. All right? Now, notice this big move. Now, we all know why this happened. This was China. But we also know that it went right down to the target. All right? Because the market already knows it. The market knows the targets from already. Even though the news has come out later, they already knew where the target was, and they took that whole move right there. All right? Now, we're looking for this break. We're looking for it to continue down here. If it breaks below here, we're going to go below here. All right? This is how we trade, day in and day out. We're looking for those two trades. This is what we call a snowman. We love snowman. It's an area where you got two wide open spaces on top of each other. Here's the snowman. All right? And this is trade 1, and this is trade 2. Right? It's because it is technical analysis with the right tools. That's what it is. You can be a farmer and have a mule, or you can be a farmer and have a John Deere tractor. You will certainly be more successful, make more money on your crops if you use a John Deere tractor. All right? But you can use a mule if you want to. All right? You're still a farmer. All right? So, I mean, all these charts, that's what we're looking for. We're looking for these opportunities. We're having a pullback here. See, this is great. We've had an unsustainable trend, so we know they're going to pull it back. We're looking for it to come all the way up here and square up. When it squares up, this is trade number 1. This is trade number 2, but we have a barrier right here. So we know where that barrier is. Trade 1, trade 2, but because this barrier is a day chart bottom, we're going to move our stop. When we get tight to here, and maybe we'll break into this area down in here. See? All right. Is it making sense, folks? Can you see it? Look at this trade right here. This is the Aussie. Can you see how easy it was to make this trade? And can you see how easy it's going to be to make the next one if they break in here? All right, look at that. Wide open space. How far was that? 1, 2, 3, 4, 5 T30s. These are little T30 lines based off the pivot point. That's 150 pips in here. There's a 150 pip trade. Bam, right there. Look at this trade. If we get this trade, oh my gosh. That's called money. Money, 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 money. All right? Notice when they got this wide open space, they took that trade. But when they got that one, they took that one. All right? That's what they do. And that's how we trade. And we do not trade in the junk. We only trade if we have a wide open space. That's the only place we will trade is in a wide open space. All right, I'm going to open up for questions. Anybody any questions? Anybody? I guess it's a one-way deal here. Nobody got any questions? I got Michael's typing, so. Well, you know, it's like anything else, David. It's confusing. It's like the first time your dad or your mom put you in a car and said, "Okay, son, you're going to drive now," and you go, I can't drive. I got to move the clutch. I got to move the gas and the brakes. I got to put the turn signal on. I got to look at the mirror. I got to look in front of me. I got to look behind me. I can't do all that. Now you drive, and it's easy. See, but anything you do in the beginning, it looks daunting, but in reality, it's very simplistic. All right? Yeah, exactly right, Celso. We use our MACD for divergence, all right, and we also use it for trending. Okay, so when I take this down to a 10-minute chart, let's take the Aussie down to a 10-minute chart. All right. Now, we only want to trade with the big boys. That's all we want to trade at is the big boys. Now, we look at the day chart, DC, for, this is a great question. We look at that to find out where the top and bottom is and any barrier that the day chart would provide going to the target. So we do want to know where they are, but we don't trade the day chart because the day chart targets are really, really big. Number one, they take multiple days. If you were a position trader, that's what you'd be doing. In fact, what you'd be doing is what we're doing on a 240 chart, you'd be doing that on a day chart if you were a position trader. So this is ours. We built this. We built these charts to show it. That's what we did. So these are our charts. All right. So let's see what else. I want to show you this. Okay. So what we do on here is we want to. This is when I'm on a 10-minute world. The only thing on this chart that comes from the 10-minute world is these candles. That's the only thing. This moving average right here comes from the 240-minute world. This moving average that's green comes from the 60-minute. That's why it's faster. It's 4 times faster. Okay. This little one right in here comes from the 30-minute world. This is a T3 from the 30-minute world. This MACD is from the 60-minute world. Why do we want to see all those big time frames? Because the big boys have never seen a 10-minute chart. They don't trade down here. They trade on a 60-minute. They enter and exit on a 60, and they trade the 240 or the day chart. All right. So we want to see where their lines are. What are they looking at? Okay. So what we do is we mark the 0 line break. All right, up or down. And this is why here's a MACD crossover to the downside. Anybody who took it right here, and that's what they lost their shirt. All right, moving average crossovers are terrible. They work great in a market that's trending. The market only trends 30% of the time. 70% of the time, the market does not trend. Therefore, if you're using a moving average crossover, 70% of the time, it is the wrong trade setup. 70% of the time. All right, but we mark it for you. For instance, when we get the moving average crossover here. That would be right there on that candle right there. Notice where we get our signal. Our signal's way before that. So what it tells us to do is move your stop and hang on. All right. The rest of the world got their signal, entered a buy right here, and had to live through the retracement down here. Why? Because it takes this much movement to create the moving average of the crossover. And the big boys know that all the dumb money is going to jump in on the moving average crossover. And so the next thing they do, yes, it is, Celso. The next thing they do is they pull it down. Why? Because they can pop your stops. All right. Once they get the retracement in, then they go. When we get the retracement done, look what we get: a 0 line breakover back up to the upside. So we mark it for our traders so they can see where it is, but we don't trade it. It's not tradable. That's what we do. But we use the MACD to find divergence. Like on here, we would go over to, we have another setup that's solely for reversals and retracements, that kind of thing. And it's a little bit different chart. But we can see right now that on the Aussie dollar, and we use the 60-minute chart for that, we have divergence on the Aussie dollar. So we're anticipating that the correction will happen, not the breakout to the top because of that divergence. Let's go back to the chart. And you'll see why what we're looking for here. Let me go up to 60. All right. So we know we have divergence, but we also know one other thing. Let me pop this down a little lower. These are the targets from the 240 world, but I've taken it to the 60-minute chart. We have divergence, so we see that. We know that the divergence on the down on the other chart is already showing it there. All right. So what we're anticipating is an ABC retracement, and then we will get this trade up to here. All right. So we're not trading right now on this currency, even though we're above here. But because they're above this line, they've told us we're going to try to make this move. But we first got to get a correction done. They have not squared up this candle, so it could come down as low as this. So we could have a 100-pip retracement before we get the buy. Now, guess what? A 100-pip retracement is going to be great for us. We're not going to try to trade this 100 pips. We're going to wait for them to do it, and then we're going to take the bounce. Now we got a snowman, a 2-part trade to the upside. So what ends up happening to us is we make way less trades than the average retail trader does. We only make 10 or 15 trades a week. All right, that's all. All right, but our average trade is 54.6 pips. Our average trade is 54.6 trips. We've only had 53 losses since January, and we've made over 600 trades. And our average trade is 500 pips. So that's how it works, right? So if you know where the market's going and you understand market structure, then you have a shot at it. If you're trying to scalp 10 or 15 pips, you must be right 90% of the time for the rest of your life if you're trading for 5 to 8 pips. And that's what the average retail trader trades for, 5 to 8 pips. So they've stacked the deck where they have to be the greatest trader on the planet. You have to be 90% correct in order to trade that way. It's not possible for you to be 90% correct for the rest of your life unless you are the greatest trader in the world. All right? That's right, Peter. Well, that's true. That's why you have to learn where to pick them. All right? So we pick them off the 60-minute chart. We want to see what we don't want to trade with anybody but the big boys. I don't ever want to trade with you guys. I'm never trading with you guys. I'm going to trade with Deutsche Bank. I'm going to trade with Citibank. I'm going to trade with Wachovia. I'm going to trade with Bank of America. I'm not trading with you guys. All right? So that's why we trade up on the 240 and the 60-minute chart, where we're trading with the big boys. And after you spend some time doing it, you'll learn how to find the big boys' targets. Once you know where the big boys' targets are, then you know exactly how to make the trade. All right? So this is about an hour. That's about what we wanted to go. So let me pop up one thing here. So I do want to invite you. We have 6 free trading lessons on the chart on our website. In fact, tonight at 8:30 Eastern Time. I agree. Exactly right, Peter. 7:30 tonight, we're actually finishing up the 6th lesson, and then we start all over. Every week we do a free lesson for beginners learning how to do this, okay? They're all recorded, so you can go watch them anytime you want to. Every Monday night is a beginner's live target trading class. That's tonight. You can get a 10-day free demo of our software, and you're in the live room with me. We trade live every single day in the New York session, and we don't do the London anymore, sorry. And if you take a demo, I'll give you a free ebook, 32-page ebook on how to Forex target trade. It's just all free, all right? So the thing you need to do is you need to say, well, this looks interesting to me, but maybe it's a little convoluted. Well, yeah, it's new to you, but why not take a free demo and try it? The lessons link in this page, yeah. Okay, hold on. Let me break it down. There you go. I'll pull up the website real quick here. One of the things that we do in the live room, we take our traders' trades, not my trades. We take what our traders trade. So far this month, our traders have taken 1,723 trades out of the market. Pips. 1,723 pips so far this month. That's what our traders have done. All right? And over here in learning, you'll see beginner's lessons right there. Just click right there. And if you're a raw beginner, you start at the top. But if you just scroll down here at the bottom, there are 6 lessons right here. They're all recorded. You can go through them starting right there. How do we verify that? You go in the room and the traders tell us every day what they made. All right? We do it every day because we identified the trade yesterday. All right? Now we just do them in the room. We don't have time for that. We don't have time for that. Some of our traders use my FX book, but remember, I got thousands of traders. All right? So what we do is not everybody takes the same trade. We might identify 12 trades. And 40 took this one, 20 took this one, 10 took this one, 60 took that one, whatever. And so we do that. Same thing if they lose. If we identify a trade and they lose, we count the loss. All right? We count them both ways. So it's the way it works. All right? So it's not my record at all. So what you need to do is come in the room and see for yourself. All right? That's how you do it. All right? Go in the room, take 10 days and spend an hour, 2 hours a morning in the New York session and watch us. And you'll see it happening day in. You can also watch up here in the training room, training archives, right here. Everything we do is recorded right here. So you can see them right here. Everything we do. And then, of course, at the end of the session, we do a session recap. And right up here, session recap. And we do about a 10-15 minute lesson recap every day of what we think we might happen. And this is what we verify the next day. Today we'll tell you where the trade exists because it's a wide open space. Tomorrow, we've identified it today. Tomorrow at Traders Take It, 40 traders said I took the same trade and I got 46 pips, I got 52, I got 98, I got 40, whatever it has to be. That's what our record is not the highest, not the lowest, it's the average of what our traders took every day. So it's there. It's just a recording we do every day for our traders, and it's all recorded, just like this was recorded. So it's all there to be verified. So, all right, everybody, we've been going an hour, and so that's the deal. And I want to thank you for being here. If nothing else, hopefully you learned some things you didn't know, things to look for in the market, and you know, we're here to help traders learn. So, all right, everybody, have a great day, and hope to see some of you in the room tomorrow. ProactTraders.com. We'll see you later. You bet, DC.